Good evening, everybody. Welcome. Happy election day in the United States. It's the 7th of November tomorrow. This is the FOMC rundown for that. Now, what we're going to do today is we're going to go through the FOMC expectations, talk about market pricing. We are going to cover, of course, the September meeting, talk a little bit about that meeting, then also discuss what Powell's told us recently, as well as his right-wing men, Williamson and Jefferson. And then we'll talk briefly about the statement and move on, of course, to some of the key charts. Really focus in on some of the key charts now, particularly as that election is out of the way. Where are those key opportunities tomorrow, of course, during the FOMC, but also beyond that? Because I think what comes next into the year end is a little bit more straightforward, given what the charts are currently showing us. Okay, now, if there are any questions, do post them in the chat box. These sessions are for you traders, so do ask those questions. Okay, the only way you're going to learn the FOMC and any central bank for that matter is to ask the questions and learn and iterate through these sessions. Now, for our Tradelo traders and for those that are not yet members, we do have a new application on the way. We have been hard at work redeveloping into a full web application to be launched hopefully in late December. The new application will, of course, include automated risk management, data analytics, trade journaling, trading education, live streaming, verified leaderboards, and so much more. So do stay tuned for that. There will, of course, also be a free tier. So it's one of those things where you can try it, experience it, find the value in it, and then make a decision to join the Tradelo community. Of course, as always, it really helps us that you subscribe to YouTube, like the videos, share the videos, comment on the videos, and if there's content you really like, that's your opportunity to post it, because we do take those comments and work from them. So that is at Tradelo Trading on YouTube. Now, like we do every single session, the way we start these sessions is we try and frame it. This enables us to understand where the opportunity scope is. Now, the way to frame this meeting, November meeting, is very simple. Will Fed policy stimulate too much inflation or not? Okay, and this is kind of the key we have to answer as we move into this November meeting, because the answer to this question will dictate and determine whether or not the Fed chooses to pause at December or not. Now, keep in mind, as per the dot plot that we got in September, the thinking was that the Fed would perhaps pause or even cut again at the December meeting. It was evenly split. In other words, there were 10 members talking about one more additional cut this year versus 9 talking about an additional 2 cuts. Okay, so it was very evenly split about whether or not we get that December cut. And that's what the market wants to know. Are we going to get a pause in December? Or is it a case of, nope, they're going to cut in December and then perhaps begin the process of cutting at every other meeting only in 2025? Now, this is the break-even inflation chart, and this is the chart that no doubt the Fed will be paying very close attention to. Why? Well, because what we can see is that when Powell pivoted back earlier in the year, we can see that break-even inflation rallied to the upside. If we then fast forward to September, where they cut by 50 basis points at an insurance cut, we can see that was also the low in break-even inflation. Now, this isn't necessarily problematic, so as long as we don't see that chart moving up exponentially, because at the end of the day, don't forget, the whole purpose of the Fed beginning the process of cutting rates is to stimulate a little bit of demand, to safeguard the labor market from falling too aggressively. That's what they're intentionally trying to do. They're intentionally trying to remove a little bit of the restrictive stance they've had over the course of the last year and a bit, because they believe inflation is back to 2%. Okay, so right now, so long as these inflation break-evens remain contained and do not break to the upside, there is absolutely nothing to really worry about at this point. Okay, now, as we go over the course of the session, we're going to talk a little bit about economic data, and then we're going to move on and talk about some of the thinking and the ideas for the meeting tomorrow. Now, we continue along the story of December. What happens in December? Because tomorrow they're going to cut. That's expected. That's priced. We don't even need to debate that. It's about very much what comes after tomorrow's meeting. And that's what we want to try and understand, utilizing the key economic data. Why? Because this is what the central bank Fed members are telling us. They're telling us we want to look at the totality of the data. What do they mean by totality? Well, we want to look at PCE, which reflects inflation. We want to look at the unemployment rate. We want to look at non-farm payrolls. We want to look at job openings. Okay, all of these things in totality will ultimately form an understanding of what they do in December. Okay, that's why we look at these charts. And the first one is PCE. And it's a very straightforward chart. We can see the orange line is ultimately the actual print that's just come out. And we can see, bang, it's at the Fed's 2% target. If we look at the 3-month average, sure, it's a little bit elevated around 2.4, but the trend is very firmly intact that inflation will be back at the Fed's target in very near term. Okay. Now, the Fed's projections is that we'll average 2.3% for this year. They're projecting still slightly above that 2% for next year. But again, it's pretty much a target. Remember, they don't target an exact amount. They target an average inflation rate. And then finally, they believe they'll be at the absolute target by 2026. Okay. In other words, the Fed thinks the inflation job is done. Okay, like I said, the disinflationary trend continues. PC is back at 2%, and the Fed has got room to remove tight financial conditions. That's the key crux, and that's the most important thing to understand right now. Current Fed policy is restrictive, and they've got a lot of room to get towards that 2.6%, what they deem the neutral rate. Okay, currently we got the Fed's rate around 4.5%, so they've got roughly, call it 200 basis points of cuts before they get to the point that interest rates are not stimulating, but they're also not restricting. Okay, so a lot of room to cut. Now, keep in mind this construct that if inflation is already a target, what that means is that the Fed can quite happily continue cutting if they are confident that this inflationary trend remains intact, because ultimately that will give them that guarantee of a soft landing. Okay, now, JOLTS was an interesting one because that one jolted markets over the course of October. We got quite a weak print there, quite a significant drop. And we can see the combination of the last 3 JOLTS openings is something to sit up and pay attention to. Okay. Yes, we can see again the 3-month trend is to the down. We can see the actual numbers are printing down. The JOLT opening numbers are dropping off quite aggressively. However, let's put this into context. We are still well above the long-term average of around 7 million. In other words, in a normal economy, a COVID type economy, 7 million jobs is kind of what's expected for a good economy. Okay, and we're still trading above that. So contextually, they can be dropping off quite aggressively, so long as they don't, drop off massively below that 7 million mark. That might start to create a bit of problem. Okay, now, the unemployment rate's an interesting one because this is what created all a bit of panic and actually led the Fed to cutting 50 basis points. It was the triggering of the SAM rule. We got that, of course, when we ticked up to 4.3%. Everyone was talking about a near-term recession. The US was in a recession. And as you'll see in a moment when we go through a couple of the charts, the markets responded accordingly. Okay, now, one thing I would say, again, we've got the green line, which is the 3-month average. Sorry, yes, the green line's the 3-month average, the orange line's the actual print. We can see the actual print has come back to 4.1%. The Fed thinks that we will average 4.4 by the end of this year. Now, keep in mind, this was a fresh projection just back in September. Okay. Now, given what we've seen in the last 2 non-farm prints, the Fed may perhaps be adjusting that Fed dot projection in December to be a little bit lower. In other words, maybe they overreacted to what they thought the unemployment rate was going to be at the end of this year. Okay, and that's why they cut 50. They obviously had these projections. They believed unemployment was going to tick up to that 4.4%, which would have triggered that SAM rule, triggered the so-called recession rule. They were concerned about it, and that's why they cut 50. Now, we're back at 4.1. That's kind of moving in the opposite direction of what they thought, and it's going to require quite a bad non-farm payroll print in the penultimate non-farms in 4 weeks' time to get us up to that 4.4. So they are pretty much going to miss that projection. Okay. However, the point stands. I think unemployment will stay a little bit elevated, not problematic, just elevated for 2025 and 2026. Okay. And this is despite or inclusive of the idea that they're actually going to cut rates. Okay, so they are cutting towards that more neutral level, and they recognize that they've got room to cut because inflation's coming down, but also they want to safeguard this from turning back to the upside. Okay, now in terms of the actual non-farm payroll prints, this is an interesting one. We did have a hurricane come through the United States that created a very, very interesting print. It was quite a significant print miss on the expectations. And don't forget, the expectations do factor in hurricane implications. Now, this is not unusual. We, of course, have had hurricanes impacting payroll growth before. Now, typically what happens, and this is the key part to understand, the non-farm payrolls print after a hurricane print. In other words, we got a really weak print, but everyone ignored it. Why? Well, because it was hurricane influenced. But what typically happens, and this is what you have to pay attention to, there's always a rebound. Okay, now what you do not want to see at the December non-farm payrolls is the number missing to the downside again. Because remember, economists will be forecasting in a rebound in the payrolls. If we don't get it, if we see a miss on the expectations and a healthy miss, that's when the market's going to scratch its head and say, uh-oh, what's going on in the payroll print? Okay, now, one thing I want to point the attention to is, again, that average. It's not exactly turning up and to the right. Okay, and this is important to stress. Powell told us in September he believes 100,000 job payrolls is not a sufficient amount to keep the unemployment rate from rising. In other words, he thinks we've got to be printing at least an average of 100,000 to sort of safeguard that unemployment rate ticking up. Okay, now the average 3-month average is exactly 100,000. Okay, in other words, if we don't get a really solid print in December, we are going to start to see that unemployment rate tick up, and that's ultimately what's going to keep the Fed on this cutting path. Okay, don't forget, right now the Fed is not thinking about a pause. Right now the Fed is thinking, is this labor market or these risks to the labor market, are they reducing or not? And the short answer is no, they're not. Okay, sure, the unemployment rate might be at 4.1%, but it's not like that 12,000 print gives them any degree or any more confidence, over the last 3 months. Okay, so right now the labor market remains a concern. It's not weak, but it remains a concern. And because they've got 200 basis points of leeway to cut, guess what? They're going to keep cutting. They're not going to hang around because they don't need to. They've got inflation back where they wanted to. They would rather cut early, safeguard any risk of the labor market weakening further, and then fine. If the labor market starts to improve, if we get a really good print in December, guess what? They can pause in January. They can pause in March. All right. That's the key takeaway. It's very, very unlikely that the Fed is going to have more confidence on the labor market of the data, given the last 3 months of data. Okay. Now, let's talk about financial conditions because this is an important one. And we'll talk about this when we get to the key charts at the end. But right now, what we've seen is actually some de facto tightening. And I think this is something that will play in the minds of the Fed. Don't forget, we have seen yields rally quite aggressively. We've done 80 basis points, 80 basis points since that September meeting. And this is at a time when, of course, the Fed is cutting interest rates. Okay, this is not what they want to see. What they don't want to see is yields rise when they're cutting, because that effectively reduces the impact of their rate cut cycle. Okay. So again, if they lean on this idea that sure, they're cutting and the market is responding this way, they're not exactly going to turn around and pause. Okay, they're going to keep cutting because the market's giving them that room to keep cutting. Okay, now what you see on the orange is the 2-year yields. Keep in mind that the Fed's rate cut projections, they're expecting perhaps 1 or 2 more cuts this year. Like I said, it's very finely balanced, and that's why it's a key theme for this meeting. But next year, they're talking about 100 basis points of cuts. 8 meetings a year, that means a cut at every other meeting. Okay, and then, of course, a few more cuts by the end of 2026, perhaps somewhat towards neutral. Okay, so the thinking is another 100 basis point cuts next year and another 2 cuts the year beyond that, or perhaps more, and get towards that neutral rate. Okay, now, the point I want you to take away from this is that conditions are tightening, and that gives the Fed room definitely to cut tomorrow, and also right now the optionality to cut again in December. Okay, because it's not like the market is exactly sending any concerning signals. If anything, it's showing signals of a very, very strong situation in the US. Okay, now Let's talk a little bit about Powell from the 30th of September. This was the last time he spoke, a little bit dated. Okay, it's very unusual. I'd lean too much on Powell's statement, but the reality is he, of course, didn't want to talk too much as we moved into the final weeks of the election. So he last spoke at the end of September. This was obviously pre the October non-farm payrolls as well as the November non-farm payroll. So we don't actually understand or have an update on his thinking around the labor market. Okay. And that's the key. I'll summarize this for you in a minute. But if we look at what Powell's justification was for the cut, the 50 basis point cut, they were talking about this idea of a recalibration. Okay. Or another word for that, it was an insurance cut. Okay. Like I said, they were concerned unemployment was going to be at 4.4 average for this year. They were worried about that. They got ahead of it. They took the insurance cut because they could. Okay. They had a lot of room. They were very, very restrictive. And so they had quite a good opportunity to recalibrate. Okay. He also said, we do not believe we need to see further labor market cooling. In other words, we're in a position now where we can keep cutting because the labor market's not going to stimulate demand. It's not going to create an inflation problem for us. Right? He then told us policy will move toward more neutral stance over time. Okay. And this is very, very important. This is that gradual at every other meeting. And again, this wasn't necessarily something new. This was what he told us, of course, at the September meeting during the Q&A. He told us Fed is not in a hurry to cut rates quickly. They'll be guided by the data. If the economy evolves, it would mean 2 more cuts this year for a total of 50 basis points. Okay, so we know he leans on 2 more cuts this year. That is his stance. He is the boss. His job is to get everyone on his team. So again, we as traders have to lean on that. The market is thinking 2 more cuts this year, and Powell's thinking 2 more cuts this year. And that means that's probably what we're going to get, barring some significant change to the strength of the labor market. Okay, that's perhaps the only thing that could consider a pause, but for all intents and purposes, we're going to get 2 more cuts this year. Okay, and then of course he told us the level of payroll job creation is down pretty significantly from earlier, and this is the key. This is really the only thing that matters for the Fed. They are safeguarding the labor market, and if we want to summarize the 4 points, it's a gradual cutting cycle. So cut November, cut December. Look at the data, perhaps pause in January. That's the logic. They're cutting. Why? Because inflation is 2%. The problem of inflation is solved. Now it's the problem of guaranteeing the labor market doesn't weaken any further. Okay, and because they've got a lot of room to cut, they are just going to cut. They're going to get on and get towards that neutral rate, so long as the data allows them to do so. Okay, and that's it there. We're worried about payroll job creation. Like I showed you, we're at 100,000 jobs per month average over the last 3 months. That's a problem. Okay, that trend in payroll growth is not exactly turning up. It's continuing down. And that means the Fed's just going to keep cutting. Okay. Now, let's go and talk about Fed's William. I'll just briefly go over it. He spoke on the 10th of October. He told us 2 things. The pace and size of future cuts to be determined by economic data. And that's important because we can never rule out the Fed cutting 50 again. I think if in December we were to get a very, very weak print, okay, a 50,000, right? Yes, don't be surprised to see rhetoric ramp up, not just for a January cut as well, but perhaps even more than 25 basis points at the final meeting of the year. Okay, right now, the Fed is squarely focused on the labor market, and they will do anything to prevent it from, suddenly falling out of bed. Okay, and then finally, job market is unlikely to be inflation driver going forward. Same thing, which is they're not worried that the actual labor market will create any inflation. Okay, inflation is just simply not a concern. We look at Jefferson. He spoke on the 9th of October. Again, reiterated this recalibration. Told us that economic growth is solid. Inflation has eased substantially and the labor market has noticeably cooled. Okay, again, that's that theme of the labor market. And then he told us that the rate cut was neither proactive or reactive. Okay, again, perhaps just trying to explain themselves. At the end of the day, it was an insurance cut, and that's all you need to know. Okay, now, the Fed Whisperer, Nick Timmermans, actually had a very tough time of writing an article this month. He's good to read. He explains things very, very well. He frames the meetings very well. He's mentioned 1 or 2 clever things here, and I think that's probably why we want to go over it. But by and large, he's had a tough time this month. I think this is a bit of a tricky meeting in that we shouldn't expect too much from it other than cut, keep open December, move to December, watch the data, say as little as we can and get to December. Okay, that's sort of, if I'm going to summarize tomorrow's meeting, I would be very, very surprised if we got anything of interest out of tomorrow's meeting. Okay, sure, we hope and we prepare for certain scenarios, and we'll go through those scenarios in a minute. But the point is that tomorrow's meeting could be a little bit of a damp squib. Okay. Now, Nick has introduced a few ideas. The one, as I said, is this idea of December. Okay, what is going to happen at December? Of course, it was very evenly split via the dot plot projection. We had 9 members thinking only one more cut this year, and we had 10 members thinking 2 cuts. Okay, Powell was in that 10-member thing, group, and that's why I very firmly lean, and the market very firmly leans on this idea that they will again cut in December. Moreover, if we look at the data, they've got every right to cut right at this point in December again. Okay, the labor market is still perhaps problematic as per that non-farms 3-month average. Okay, now Nick has introduced this idea. There's 4 questions, or there's 4 key takeaways that we want to kind of draw out of the meeting. The first one he said is, does the election result matter? Okay, now this is an interesting one. I didn't know this once I'd read it, but ultimately, Powell will try and dodge as many questions about the election and as he can. They obviously want to remain apolitical, but ultimately, the reality is that Donald Trump's policies, given he has swept, he will have little holding his hands back, particularly from a tax standpoint, from a tariff standpoint. And what did happen when he became president in 2016 for the first time is that the Fed actually conducted a review at the December meeting, and they came out and said that yes, perhaps his policies will be inflationary. It will impact our forecasts. Okay, I suspect we'll get something similar, which is at the December meeting. I suspect the Fed will include into its forecasts the implications of a Trump presidency. Okay. Now, again, they'll have a lot more data than what we have, but the logic is that they should be revising up their inflation forecasts for the December meeting. And that will, of course, be interesting because if they're going to revise it up significantly, it means they'll perhaps need to revise down how many times they think they'll cut over the course of next year. But again, something we'll talk about as we get to the December meeting. But just be aware of that. He will get asked about this question. President Powell, given Trump's in power, do you think inflation expectations will be higher next year? Do you think your forecast will need to move higher? Listen how he answers it. Okay. I think he will lean on 2016. He'll probably tell us they're going to do a review and they'll get back to us in December. But again, if he comes out and he says, yes, we think there is a risk, he's telling us that perhaps they may still cut in December, but then there's definitely a pause beyond that point. Okay. The next question was with regards to the job market. Okay. And this is actually the other side. Nick is taking the other side of the coin here, which is to say, look, did you guys overreact off of one non-farm print? Did you overreact and suddenly cut 50, because you thought unemployment was going to be at 4.4%? Okay, and I think this is a question he will get pegged on. Chairman Powell, did you guys overreact or not? Again, if you look at the data and the totality of the data, everything points to such a situation of, yes, recalibration was justified. And it's not exactly like the labor market is, performing, extremely strong at this point. Okay, sure, it's not going to reach that 4.4% average unemployment for this year, but it's not exactly rebounding and showing some significant signs of strength at this point. Okay, third question was all about where inflation is headed. He's leaning on this idea of, we're at 2.1%. Ultimately, where do you think inflation's going? Is it going to settle here? Is it going to be sticky? Perhaps a question that gets brushed off. I'm not sure the Fed cares too much at this point about inflation. They think they have that well under control. The final question, of course, then is the right level for rates. Okay, where do you think that neutral rate is? And again, I think this is why I said Nick had a tough time. These last 2 questions were kind of like I think he was trying to add a filler to his article. But the point is he'll get pegged on the neutral rate. Powell will come out with the same standard answer, which is we'll feel our way there. Okay, that's the short answer. They don't know where the neutral is. They're going to keep cutting. At some point, we're going to see a little bit of demand come back in. We're going to see a reaccelerated inflation, and then they're going to say, well, there's the neutral rate. Okay, that's pretty much what they're going to do. That's how they're going to feel their way towards that neutral rate. Okay, now, Fed statement, not going to spend too much time on this because there should be no change to this. The key line here, not just for this meeting, but of course every meeting, is with regards to job gains and how they characterize it, the word usage. Okay, they said that job gains have slowed. Okay, that was the big change. They specifically added this to the statement to say, look, we are concerned about the job market. Now, this is expected to be repeated. Okay, job gains have slowed. And the unemployment rate has moved up, but it remains low. there's no need for this to be adjusted. At some point in the future, this might be strengthened. Okay, so if things get worse, this may become even more aggressive. They may use some different word order. But right now, there's absolutely no change to the policy. So I'm not going to spend too much time on that today. Now, let's talk a little bit about pricing and let's get into some of the ideas and opportunities for tomorrow. The market implied thinking is, think of it as cut, cut, pause, cut, pause, cut. Okay, cut, cut, pause, cut, pause, cut. Okay, in other words, they're going to cut November, cut December. That brings them down to 4%. They've still got around another 6 cuts they can do to get to roughly neutral. 5, 6 cuts, 4, 5, 6 cuts. Think somewhere around it. We don't know where neutral is, but let's just assume it's somewhere between 2.5 and 3. Okay, so what the thinking is cut, cut. Then we'll cut 4 more times next year, which means we're kind of somewhere around neutral. Okay, that's the logic from the Fed, and that's what the market's thinking. Okay, they're not 100% certain of that December cut, only 42, 43 basis points, but that's quite a convicted pricing from the implied odds. So again, a lot of the questioning tomorrow will be about that December meeting. Like I said, Powell's very firmly in that camp of another cut, and I don't suspect he's going to push very hawkishly against it. Okay, right now the Fed wants full optionality. They go meeting by meeting, which means why give up the optionality unless you're 100% certain the labor market is actually rebounding, and they're not. That's the reality. Okay, and again, that's why I lean on this idea that tomorrow's meeting could be a little bit boring, but this is the key. If I do see rates markets move tomorrow, okay, and this is kind of what I'm pointing to over here, what changes the policy path? That's how you always have to think about any central banking meeting, okay? And the guys that have done the central bank course with Tradelo, you'll know this chart. But we have to ask ourselves, right now, the market is pricing in between now and call it September next year, 100 basis points of cuts. Okay, so if you assume this line is 100 basis points of cuts change between now and that meeting, we have to ask ourselves what changes that dynamic. Okay, now if inflation suddenly starts to reaccelerate, then fine. What we will see is we'll see a much shallower path of cuts, perhaps only 2 more cuts and then pause. But as of this meeting, we're not seeing inflation reaccelerate, and there's no concern about it. Okay, if we were to see the labor market suddenly rebound, okay, then fine. Maybe we see the rate cut cycle shallow a little bit, less cuts. But the reality is we're not seeing that. So there's very little in the way that could shift this ultimate policy pathway right now, because it's pretty much pricing in exactly what the Fed thinks. And I'll show you that chart in a minute. Okay, the point is that there is not a great deal that Powell could say tomorrow that'll actually shift this rate curve. Okay, and if the rate curve did move, if there was a little bit of volatility in it, perhaps 2 basis points that way or 2 basis points that way, I would sit there, lick my lips, and fade the damn market. Okay, because there is very little in the way of policy and something Powell could say that could shift that tomorrow. Okay, now, this is the chart I want to show you because this is a very, very important chart. This is effectively the implied rate path. This is that curve like I was just showing you, all right? And what it's telling us is that right now, the market thinks somewhere between 85 and 100 basis points of cuts are coming between the current rate and 1 year from now. In other words, the end of 2025. Okay, what does the Fed dot plot tell us? The Fed dot plot tells us we've got 100 basis points next year, as well as, of course, another 40 odd this year. Okay, in other words, right now, the market is pricing almost more or less what the Fed tells us they're going to do. Okay, in other words, the Fed and the market are in conjunction with each other. What we can see, and this is what's interesting, we can see that from June, July, August, the US data started to deteriorate very aggressively. Okay, we had a very bad non-farm payrolls at the start of August. Everyone was talking about the SAM rule and the recession, and we could see the market suddenly started pricing in very aggressive rate cut cycle. Okay, it started pricing in almost 150 basis points more cuts because of the deterioration in the data. We then paused. All of a sudden, the Fed cut 50, and the data started to improve. Unemployment's back at 4.1%, and now the market has just said, well, okay, pretty much we think the Fed's going to cut 4 times next year, and the Fed says they're going to cut 4 times next year. Okay, so right now, the curve is pricing in exactly what the Fed's thinking, and that's good for the Fed. That makes the Fed happy because it means they can just get on with the job and do what's expected. Now, this is a very important chart to pay attention to, perhaps not during this meeting, but definitely over the course of the next couple of meetings. If we take a look at the 2 lines, we've got In purple, we've got the 2-10s curve. You would have heard a lot about this. 2-10s is steepening. That means it's a recession. It's disinverted, blah, 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 all that sort of fancy stuff. In the blue line, what we've got is just 2-year yields. Now, what you need to understand and what's important is, like I said, from June, when we had the weakening of the day, June, July, August, okay, very bad non-farms August, we can see that yields got smoked. Why? Market was pricing in a very, very aggressive rate cut cycle. Why? Because we're in a recession. It's the end of the world. We need to get ahead of the Fed. The same time, what did the curve do? It very aggressively steepened. Okay, that's expected. Everyone bought the front end, and ultimately the front end needs to price in those rate cuts. Okay, at the same time, if they are going to stimulate and cut that aggressively, the back end's going to lag because we're going to get inflation and growth expectations at the back end. As simple as that. Very straightforward. And that was the bear steepening that took place. Nothing unusual about that. What should be piquing your interest is we've now gone from a bear steepener to a bull steepener. Okay. And again, this isn't necessarily problematic until it is a problem. And that's why you have to be aware of it. Okay. At this part of the cycle, when the Fed is cutting, we don't want to see a bull steepener. Why? Because if the Fed is cutting, yields should be moving lower because it's lower yields that stimulate the economy. If yields are moving higher, their cutting policy is not filtering through into the real economy. In other words, their cutting becomes ineffective. It means nothing because at the end of the day, when investors hedge or when investors want to go get a mortgage, they're mortgaging themselves at very high rates. Okay, so this bull steepener matters at a point. Right now, the equities don't seem to care about it, but it will become a problem should we continue to see this not just steepen, but bull steepen. Okay, in other words, yields are rising and the curve is steepening because that means effectively, like I said, those Fed rate cuts are not just ineffective, but the back end is starting to price in some much higher yields. Okay, very important chart to pay attention to. Bull steepen is not something you want to see, particularly given that equities are record highs. Now, we'll talk a little bit about the Santa Claus rally because I'm not sure this is a problem this year. I think this is perhaps a problem for next year. Now, VIX, important chart. This is kind of where I think the key thesis for equities is for the end of the year. It's very simple. So long as those yields do not continue to bull steepen aggressively to the upside, we should continue to see that VIX get squashed. Okay, this is very typical. If you were on the call for the election rundown, you would have seen in 2016, in 2020, this is normal. The VIX gets crushed. Everybody's happy. And guess what? Trump's policies are really good and very stimulatory for the economy. Okay, so the point is that everyone loves the Trump idea. Wall Street loves it. The VIX is getting crushed. And that means that we could well begin the Santa Claus rally quite early. Okay, does that mean we're going to go up and to the right in a straight line? No, perhaps not. But it does mean that 6,000 is going to perhaps be trading relatively soon and perhaps even beyond that. Okay, the point is keep an eye on the VIX so long as that stays at these lower levels and continues to move lower. That really does give Wall Street the ammunition and the confidence to just keep going with the momentum. Okay, don't forget, particularly when we break out to record highs, when we go into price discovery mode, if the VIX is low, there's very little risk involved in going long at all-time highs. Okay, and that's what creates that momentum. That's what creates that very annoying bid up every single day, and it never seems to go down. Okay. Stick to the VIX. Don't overthink it. Yes, I appreciate it's overbought. Yes, we have rallied 30-odd% from October lows last year. Yes, on some metrics it's overbought. Yes, we are perhaps late cycle, but right now, current market conditions suggest VIX lower, equities to the upside. Okay. Now, gold's an interesting one. I was quite adamant gold was problematic areas going into this election result. Why? Well, because everyone was long with gold. Okay, when you have Druckenmiller and Paul Tudor Jones telling you gold only goes up because Trump is inflationary, what they forget to tell you is that's a sort of a 12 to 24 to 36 month time horizon. So gold's having a shakeout here. That's all it is. Don't forget, we were trading, $1,900 back in February this year. We traded up to almost $2,800. Also factor in that, we are very overbought in terms of gold, in terms of where we are in prices. And yeah, gold has every right to be up at these prices. But at the same time, markets don't move up and to the right forever. Okay, so we are in a bit of a corrective phase here. Where it stops is anyone's guess. Just look for that liquidity. Yep, 2,600 looks interesting. We stopped there in October. Keep in mind, of course, The start of the cut cycle, the aggressive cut cycle was somewhere around that 25.20s. Could we get back down there? Sure. Okay, where this correction corrects to, I don't know, but let it correct. Typically, when you do have corrective days, this is not a one-day event. I suspect it should push a little bit lower today, tomorrow. Now, what's driving this? It's this thing here called real yields. Okay, keep in mind, I showed you that bull steepener. What that means is yields are rising. Now, when yields are rising and inflation is falling, real yields are pushing up. Okay. In a pushing up real yield environment, that's tightening. It's de facto tightening. That's why we're seeing the dollar bid up. When you have the dollar bid up and you have your real yields rising, gold is never going to survive in that sort of a context. Okay. It's always going to struggle. And when you throw in the fact that gold was heavily overbought, that's why we saw not just a heavy sell-off today, but perhaps a little bit more downside in the next couple of days. Okay. That's the key takeaway for gold. It's one of those that I think you can buy it. I think you should buy it, but you don't really want to be buying it if these yields are going to continue to push higher. Okay, wait for those yields to settle down, wait for them to start to move a bit more sideways, and then fine, by all means, I think gold remains a buy-only market so long as we see higher inflation expectations over the course of next year. Okay. And then finally, S&P 500, the gift that keeps on giving. There you can see the October low. I think the key takeaway is that we are in this range, 57.30 to 59.30. We were stuck in this range for a good part of 6 to 8 weeks. We are now at the top end of that range, just ahead of breakouts of record highs. If we close strong today, we close above that 59.30 with a VIX at 16. That just points to something like this. All right, a lot of overlap, a lot of grind, a lot of two-way trade, but very much one-time framing in price discovery mode. It's just not something you want to sit there trying to short. Okay, pay very close attention to that. If the Fed comes out tomorrow, they remain open to a December cut. I suspect that gives the absolute green light, not just to the VIX to squash, but also for Santa Claus rally to start a little bit earlier than expected. Okay. One final note for the equities. Okay. If you've ever heard one of my discussions about what we call the fundamental framework for equities, they are driven predominantly by a number of things, but three key ones is right now, we've seen growth fears disappear. There was some concern over July, August that, perhaps US economy was entering a recession. That's gone. Let me rephrase. It's not gone. Growth is definitely reaccelerating. The labor market is still a bit of a question mark. But ultimately, the fear around that has started to dissipate. We also now have a very important lever for the equity market, which is not only is the Fed stimulating, but we've also got the fiscal stimulating. So we've got Trump coming in, cutting taxes, very much willing to spend. Okay, always a positive for stocks. But, and this is the caveat, bond yields are problematic at some point. Where that is, we don't know. Now, keep in mind, and this is sometimes I see this on social media land where people say, oh, if the 10-year gets to 4.5, that's a sell for equities. The truth is, it's not an absolute number that ultimately matters, because what's driving yields right now is that the US economy is growing 2.8%. Okay, it's a strong economy that's ultimately driving higher yields. So keep that in mind. Okay, if it was a weak economy with higher yields, fine. That's an entirely different story. But the yields are justified to be going higher because the US economy is relatively strong in comparison to everything else around the world. Okay, so yes, we don't want to see those bond yields continue to climb. We definitely don't want to see that bull steepener continue aggressively, because that will at some point perhaps put a little bit of an offer back into the equity markets. Okay. And then finally, the dollar. This is an interesting market for tomorrow. I think this has gone a little bit too far. And I think it will perhaps find a little bit of a, let's call it a top tomorrow over the Fed. Why do I think that? Well, the Fed's going to keep that December cut open. They're not going to commit much beyond that. They're probably going to struggle with this idea of any kind of pause. And I suspect so long as they continue the cutting cycle and don't introduce this idea of, every other meeting tomorrow, I suspect, given what we've done, okay, we are up 5.25% over the course of October month. We are back inside this massive little area, 106 to 107, where we've been for the last 2 years. So long as ultimately the Fed keeps that cutting cycle on track and doesn't turn a little bit hawkish or doesn't pause, I do suspect we'll find some sort of a top around that 106 in the dollar. Okay, there are a number of markets that are, of course, very aggressively oversold against the dollar. Think euro, okay, think Swiss franc, Japanese yen, definitely. So there's a couple of markets that you can obviously start to look for a little bit more two-way trade. Okay. Let's wrap up. Let's summarize a few things. No statement adjustment likely. That's not really where the attention is going to be focused on. It's all going to come down to the Q&A. One telltale sign of a damp meeting is a quick Q&A. Okay, if you ever watch the Fed, you'll know quick Q&As mean there was actually absolutely nothing to talk about. There's a lot to talk about tomorrow. I think there'll be a lot of chatter about the elections. There'll be a lot of chatter about the improvement in the labor market and whether or not the Fed sees it as an improvement. There'll be a lot of chatter about, could you consider pausing? What's the consensus for December? That's kind of where the questioning is going to go. And the answers to that you have to listen to. Okay, it all comes down to if Powell does open the door to a December pause, absolutely that's a trade opportunity. In which case, you've got to be long dollar and you've got to be short those bonds and short that gold again, because those are the trades that are going to ultimately pay out, particularly gold. Okay, if you introduce the idea of a pause in December, gold will offer a decent another 1% to the downside. Everyone is still sort of quite long that market. And we will, of course, see yields push a little bit higher in the near term. Okay. And then, of course, one of the key ones to keep an eye out for is the characterization of labor market risks. I think listen carefully how he talks about the labor market. Does he see improvement, or does he still think it's weak? If he still thinks it's weak, if he doesn't think anything's changed, what he's telling you is, I think we're going to cut again in December. But if he characterizes it differently and says, well, no, actually, perhaps we were, maybe things are looking a little bit better than what we expected, and maybe we jumped the gun. What he's then introducing is this idea that we may have to pause in December. Okay. And then, of course, the final Q&A will also be about, Chairman Powell, do you think you'll need to revise up your inflation expectations given Trump has come into power? Again, how he answers that, listen carefully. He'll most likely brush it away. He'll most likely tell us that they will go away and study it and then update us in December. But if he's already got an opinion on it, if he already thinks it'll be inflationary, again, what he's probably also going to lean on is this idea that we may not get as many rate cuts over the course of next year as expected.